Hey, if you're self-employed or you receive the 1099 at the end of the year, then there's a sneaky little tax waiting to take some of your income. And it's one that most overlook, and it's costing them big time. And this tax is called the self-employment tax. And you may have heard it, you may be familiar with it. But what I want to do today is kind of break it down a little bit nice and quick and kind of show you how the IRS strategically placed it on the IRS Form 1040 to make sure that they get their money. And also we can take a look at some things that you may be able to do to help reduce that amount. But let's start off first with, my name is Gene Bordas. I've been preparing taxes for well over 15 years. And my goal with this channel is to help taxpayers just like you understand taxation a little bit more, help you understand the fundamentals so that you can understand and be able to read your tax transcripts and your tax copy at the end of the year, whether you do it yourself or you pay somebody to do it, so that you can understand your financial situation, but most importantly, so that you can apply strategies throughout the year so that you can get your desired tax outcome year after year. So that's the reason why I created this channel. So let's get into today's topic, self-employment tax. So what is it? Well, it's really a tax to cover Social Security and Medicare. So if you receive a W-2 from an employer, what you're going to find is that they will pay half of the FICA, Social Security and Medicare, and then you're responsible for paying the other half. And you'll see that come out of your paychecks every time you get paid, and you'll see that reported on your W-2. Now, if you are self-employed or you receive a 1099, often what you will find is that on that 1099, taxes have not been withheld, which means that you're responsible for paying taxes on the whole amount, all of the Social Security and all of the Medicare. So now that we have that out of the way, what I want to do is kind of go into the software and share with you where the IRS placed the self-employment tax and what kind of impact it can have on your personal tax return. So let's take a look at the software. So here I've created a sample tax return and made up some information, address and Social Security number, just as an example. And what I've done is I'm put here that this taxpayer made $60,000 for the year. Okay. Then what I did is I added $16,000 of self-employment income, and that was reported on an IRS form Schedule C. Now, as I'm sharing some stuff, I'm going to be moving quickly through certain items because I know that I've already shared those in previous videos. So I would encourage you, if some of the items here, when I talk about standard deduction or taxable income, and it's something that you're not familiar with, then I would encourage you to watch previous videos. But let's go back to the IRS Form 1040. So we're going to scroll down, and I added, like I said, $16,000 worth of self-employment income. So that's a total income of $76,000. The $60,000 from a W-2 and $16,000 from self-employment. So we're not going to go too deep into this right now, but one half of self-employment is the self-employment tax is actually deductible, and you're going to see that reported here, along with the $300 that I put for educator adjustment. I put that this person is a teacher and qualified for the whole $300. So that's what made up this $1,431 here. But let's scroll down. You'll see the standard deduction of $20,000 that gets deducted from the total income, and you're left with $50,795 of taxable income. So it's very important to understand the difference between gross and taxable income, because your tax here, line 16, your tax is based on your taxable income and not your total income. So taxable income, your tax is $5,779. So now you're going to see that above this line here, above the $5,779, you have some adjustments. And below that, you have some credits that you can apply towards your tax to lower your tax. So here you see that there's a child tax credit for $2,000, which gets taken away from the $5,779, and you're left with $3,779. So now what you see is line 23, self-employment tax gets added, and then it's added just before your total tax, which means it doesn't get added before adjustments. It doesn't get added before credits. So you cannot apply adjustments and you cannot apply credits to offset your self-employment tax. So your self-employment tax is added at the very, very end, which means your tax, you have two taxes. You have your normal income tax and you have your self-employment tax. And they are two separate things. So they're going to tax you on your income. And once they figure out what that tax is, and then you apply the credits to reduce that tax, then at the very end, there's going to be your self-employment tax, which is right here on line 23. So you'll see that line 22, your income tax was $3,779. But then self-employment tax was added of $2,261 for a total tax of $6,040. So because your self-employment tax is really not impacted by adjustments or credits, there's really one main way to be able to reduce this, and that's by going back on this form Schedule C, and that is where I reported the $16,000 worth of self-employment income. Now, something that you can do, and I encourage you to do, is if you have self-employment income, usually there are some expenses related with you generating that income. And that is what you want to make sure that you include here on the Schedule C to offset that income. So here I just put $1,000 in advertising. I put $3,000 in office expense just to kind of show you the impact, right? So if I made $16,000 and I had $4,000 here between the advertising and the office expense, that would lower my net profit to $12,000. And that is what you get taxed on, is your actual net profit. Losses get carried over, profit gets carried over. Losses, don't want to go too deep, but losses can offset your taxable income, right? It can lower your income. Therefore, you have less income that gets taxed. But also, if you have additional revenue, if you have a profit, then that is what the self-employment tax will be based off of, right? So the self-employment tax will be a tax on your net profit. So you can do that. Another thing you can do too, and you can think about, and if you have somebody, a tax professional, if you're doing this on your own, we can create more videos to kind of talk about this subject, but contributing to an IRA. There's a SEP IRA, is specifically for self-employed individuals. And what happens if you do it pre-tax, then if I contributed $4,000 to my IRA, then that can be deducted from the 16, and then that could just, again, further reduce the amount that is subject to taxation. So I hope that this made sense. All right, so here's the deal. So if you have a W-2 and you had some self-employment income, you had taxes withheld from your W-2 and from your regular job, but you did not have taxes withheld from your for self-employment, then what may happen is, in this situation, is you may end up with a tax on your income of $34.25, but then a $1,695 of self-employment tax that you did not prepare for, which means that if you had here $5,000 withheld from your paychecks, and your tax was only $34.25, if you did not have the self-employment income, then you would have had a refund which would have been the difference between the 34 and the 5,000, which is roughly, $1,600. But now, because you had $1,695 added because of the self-employment tax, now you actually owe the IRS some money. In this situation, it's only $120. But I've seen situations where people owe, $3, $4, $5, $10,000+ just because they did not plan for it. Another thing you can do is estimated tax payments. So if you're self-employed or you receive a 1099, you can make quarterly estimated tax payments to kind of offset. And a good rule of thumb is, put 15% of your income aside, and you may net out okay. But I can't really say because I don't know your whole tax situation. But if you want to be safe, put 15 to 20% aside as you get paid, just to be able to then at the end of the year be able to settle up with the IRS. And best case scenario, you put all that money aside and you get a refund. And honestly, I don't see a negative with you putting that money aside, because at the end of the day, whether you get a refund or you owe money, you'll have to come out of pocket a whole lot less because you made those estimated tax payments. So I hope that you found this video helpful. This is not to go too in depth on self-employment. It's just to kind of get you to understand the different taxes and how they work. I have a gentleman right now that I know who is 1099. They're not withholding any taxes, and that's how he's getting paid throughout the year. And we just found out now, and here it is the month of August, that he hasn't put anything towards self-employment. He hasn't made any estimated tax payments to offset that. And he has no W-2 income, so he has no other taxes being held as well. So he may find himself in a situation. What we're going to do is do a little catch up right now, but it's very important that you know, because you don't want January to come, February to come, and all of a sudden you meet with your tax preparer or you go on TurboTax and you find yourself owing a large bill, right? So let's do a little bit of planning throughout the year. Let's if you have any questions, any concerns, any comments, please put them in the comments section and I'll do my best to answer those. But I also want to use that to create future videos to help educate you and folks just like you who just want to understand a little bit more about taxes and how it relates to them. So, hey, if you found this video helpful, you found some value, I would encourage you to like and subscribe and click on that notification bell too, so that you can be alerted and made aware when I drop a new video. And lastly, may tax time never catch you at a bad time. Thanks for watching.